Shares in the Asia-Pacific region are rallying, with Hong Kong stocks currently up 3.41%. This comes after Bloomberg reported that Chinese authorities are considering a package of measures worth $278.5 billion to stabilize its stock markets. Allegedly, Chinese policymakers have also put aside 300 billion yuan of local funds that would be used to invest into onshore shares through state-owned financial firms, China Securities Finance Corporation or Central Huijin Investment. Let's get a little bit more on this now with Jamil Ahmed in Dubai. He is chief analyst at online trading brokerage GTC. Thank you for being with us, Jamil. Right, for months, the Chinese government was trying to weigh the pros and cons of intervening directly in the economy, and now it seems like they will. How effective will these measures be in stabilizing the stock market, but also the broader economy?
The devil's always in the detail when it comes to these types of concepts, and typically we need to see improved Chinese economic momentum, which as of yet we have still not seen kick into gear following what was pretty much 3 years of COVID lockdowns. We're now nearly 1 year past Chinese economy opening up, but there are concerns that GDP targets will continue to be lowered. We might see a little bit of investor appetite towards the stock markets based on the world market rally that continues elsewhere, such as the S&P 500, a new record high just at the end of last week. We had the Japanese Nikkei that's hit its highest levels since 1990. But evidently, what we do need to see in China is improved economic momentum, which would raise global economic forecasts as a whole. But typically, we have two different stories here. China's more idiosyncratic. We're seeing a more isolated story because it's the Chinese officials that are pumping money into the market. But elsewhere, we've got worldwide expectations of lower interest rates over the course of 2024. And that's why the global market rally has been somewhat disconnected from what is more of an initial rally in Chinese markets from the news this morning.
Right, and Jamil, we are still seeing problems in the property sector. And could all of this have spillover effects onto other sectors in China, but also to other countries?
You never say never, but some of the issues with the Chinese real estate sector we have now been noticing for a couple of years. And so far, we haven't seen that contagion effect. But again, you never say never. We do have concerns of the Chinese economic momentum. Perhaps policymakers are not so concerned because Chinese economic growth, if you look at it compared to other markets in the same territories, globally and so forth, is still higher than the car, but it's still significantly below what was the peak of Chinese economic growth. And again, we've seen these forecasts now. It was 2027 that initially we were expecting the Chinese economy to become the world's largest economy. That was just 2 to 3 years ago. Those expectations have already been kicked back towards 2040. So yes, we are seeing some concerns about the Chinese economy slowing down. Yet we also see some signs that Chinese consumers, the everyday person in the street, still spending more than the average consumer in other parts of the world.
Jamil Ahmed, a pleasure having you on the program. Thank you. And now let's go to other top stories from around the world. United Airlines forecast a first quarter loss due to Boeing 737 MAX 9's grounding after part of the fuselage of an Alaska Airlines flight blew out. United expects to post a loss between 35 and 85 cents a share for the first 3 months of the year. United has 79 Boeing 737 MAX 9s in its fleet and says the planes will remain grounded through January 26th. One of the world's largest food processing companies, ADM, has seen a fall in its shares by 24%, its biggest one-day drop since 1929. The plunge comes after the firm's CFO, Vikram Luthar, was placed on leave as the company investigates accounting practices at its nutrition segment. The segment supplies ingredients such as plant-based proteins and emulsifiers to food. And Tencent Holdings online gaming company Riot Games plans to lay off 530 employees, or nearly 11% of its staff globally. The company said teams outside of core development will see the largest impacts from layoffs. Analysts say digital games publishers are struggling to grow as audiences hold off on buying expensive titles amid high inflation. The firm's most popular titles include League of Legends.